Profitable trading methods. Trading in the stock market is widely accepted using the following methods, and each individual can choose the one most suitable for their trading style and risk appetite. Delivery trading. Stocks are bought and held in your account for more than one day as part of delivery trading. Stocks can be kept for 2 days, 2 years, or even more than that, but they cannot be sold on the same day. The main advantage of this method is that it does not require you to book losses and allows you to benefit from long-term profits. Intraday trading. This type of trading involves purchasing and selling stocks on the same day before the market closes. Your market position should be monitored continuously throughout the day to find good opportunities for selling your stocks. Intraday trading is an excellent method of making fast profits as long as you invest in the right stocks. Margin trading. The use of margin trading is mostly relevant when trading futures and options. The broker requires you to pay the initial margin price for a set of securities you purchase. Margin is a percentage of trading volume that is determined by regulations from the Securities and Exchange Board of India (SEBI). Leverage is used to multiply profits and losses in this type of trading. Short sell trading. It involves traders who believe the market is bearish and trade accordingly. Shares are borrowed from a broker and sold on the open market. You wait until the price drops sufficiently for you to buy the stocks back at a lower price. This process produces a profit based on the difference acquired. Buy today, sell tomorrow, BTST. This is an altered version of delivery trading. Buying a stock and selling it the next day when you see opportunity for profit. This way, you won't have to get delivery of your stocks, and you won't have to pay a depository participant (DP) fee. Sell today, buy tomorrow (STB). This type of trading applies to derivatives markets that are expected to be bearish. A short seller first enters a short sale position and sells securities before the market closes. By the next day, your position will be squared off by purchasing the same securities at a lower rate.